Your parents spent 40 years building their retirement account. They lived carefully, they saved consistently, they left it to you, and the government is going to take a third of it unless you know exactly what changed in 2020 and what you must do differently. Most people who inherit an IRA today have no idea they are sitting on a tax time bomb. The rule that used to let heirs stretch distributions over their entire lifetime, spreading the tax bill across decades, was eliminated by Congress. What replaced it is a 10-year window, 10 years to drain the entire account. 10 years of distributions that stack on top of your regular income and push you into higher tax brackets every single year. Here is what that looks like in practice. David was a 52-year-old software engineer in Texas, earning $94,000 a year. When his father passed away in 2022, David inherited a traditional IRA worth $620,000. His father had named him as the beneficiary. David assumed he could let it grow and take small distributions over time, the way he had always heard was possible. His accountant called him the following January. Under the Secure Act, David had 10 years to empty the account. His father had already started required minimum distributions before he died, which meant David was also required to take annual distributions during years 1 through 9, not just a final lump sum at the end. If he took roughly equal distributions each year, that was $62,000 a year, added on top of his $94,000 salary. Combined income, $156,000, well into the 24% federal bracket, with Texas having no state income tax. Over the 10-year window, David would pay an estimated $193,000 in federal income tax on money his father had intended to pass to him intact. If David's father had converted the account to a Roth IRA 5 years before he died, paying tax at his own lower retired rate, at the time, David would have inherited a Roth worth approximately the same amount and taken 10 years of tax-free distributions, the difference in lifetime tax paid over $140,000. There was a strategy that could have reduced that burden significantly. His father's estate planner had never raised it, and David was already in year 2 before he found out. Today, I am breaking down the Secure Act, what it actually does, who it hits hardest, and the specific strategies that can protect an inherited IRA from unnecessary taxation. I am Marcus Webb. This is Benefits Decoded. The Secure Act, the Setting Every Community Up for Retirement Enhancement Act, was signed into law on the 20th of December 2019 and took effect the 1st of January 2020. A follow-up law, Secure 2, passed in December 2022 and made additional changes that every retirement account owner needs to understand. Before the Secure Act, most non-spouse beneficiaries who inherited an IRA could take distributions over their own life expectancy, sometimes 40 or 50 years, if the heir was young. This was called the stretch IRA. A 30-year-old who inherited a $500,000 IRA could take small annual distributions over 50-plus years, allowing the bulk of the account to continue growing tax-deferred while spreading the tax liability across a lifetime. The Secure Act eliminated the stretch IRA from most beneficiaries. It replaced it with the 10-year rule. Under the 10-year rule, most non-spouse beneficiaries must withdraw the entire balance of an inherited IRA by December 31 of the 10th year following the year of the original account owner's death. The IRS originally indicated there might be flexibility in how distributions were timed during those 10 years. It then reversed course in proposed regulations issued in 2022, clarifying that if the original account owner had already started required minimum distributions, the beneficiary must take annual distributions during years 1 through 9 as well, and then clean out the remainder in year 10. This clarification blindsided thousands of heirs who had been advised to let the account sit and take one large distribution in year 10. Secure 2 added several more changes on top of this. It raised the required minimum distribution starting age from 72 to 73, and will raise it again to 75 for anyone born in 1960 or later. It reduced the penalty for missing a required minimum distribution from 50% to 25% and down to 10% if corrected quickly. It also eliminated the requirement for Roth accounts inside employer-sponsored 401k plans to take required minimum distributions at all. These are meaningful improvements, but they do not change the 10-year rule for inherited accounts. That rule remains fully in place. According to the IRS, a traditional IRA distribution is taxed as ordinary income in the year it is received. Every dollar you take out of an inherited traditional IRA stacks on top of your regular income and is taxed at your marginal rate. For beneficiaries in their peak earning years, their 40s, 50s, or early 60s, That marginal rate is often 22, 24, or 32% at the federal level before state income tax. On a $600,000 inherited IRA, the difference between a well-timed distribution strategy and a poorly timed one can exceed $100,000 in federal income tax alone. Not everyone is subject to the 10-year rule. The Secure Act created a category called eligible designated beneficiaries who retain the right to take distributions over their own life expectancy. Eligible designated beneficiaries include the surviving spouse of the account owner, minor children of the account owner, but only until they reach the age of majority, at which point the 10-year rule kicks in for the remaining balance. Individuals who are chronically ill or permanently disabled, as defined by the IRS. And beneficiaries who are not more than 10 years younger than the original account owner, which in practice often means a sibling inheriting from a sibling, or a longtime partner close in age. Everyone else, adult children, grandchildren, nieces, nephews, friends, or any non-spouse beneficiary who does not fall into one of those categories, is subject to the 10-year rule. This is the group most heavily impacted by the Secure Act, and it is the group that estate planners are now spending the most time advising. If you are a surviving spouse, you have a unique option that other beneficiaries do not. You can roll the inherited IRA directly into your own IRA. When you do this, you are treated as the original account owner. You can delay required minimum distributions until you reach your own required beginning date, now age 73 under Secure 2, or 75 if you were born in 1960 or later. You can name your own beneficiaries, and if you die before your children inherit, your children then inherit from you, potentially, still as eligible designated beneficiaries, if they are minor children, or as standard beneficiaries subject to the 10-year rule. Spouses who are significantly younger than the deceased often benefit most from this rollover option because it completely resets the clock on required minimum distributions. For those subject to the 10-year rule, the central question is how to distribute the account in a way that minimizes the total tax paid. There is no single right answer. It depends on your income, your tax bracket, and what you expect your income to look like over the distribution window. But there are several strategies that consistently produce better outcomes than simply taking equal annual distributions and hoping for the best. Strategy 1. Front-load distributions in low-income years. If you inherit an IRA during a year when your income is temporarily lower than usual, a gap between jobs, a sabbatical, the year you retire, a year with large deductible expenses, that is the time to take larger distributions. Every dollar you pull out in a low-income year is taxed at a lower rate than the same dollar pulled out during a peak earning year. Think about what this looks like in practice. A beneficiary in the 22% bracket who takes $60,000 in year 1 pays $13,200 in tax on that distribution. The same beneficiary in year 7, now earning more and sitting in the 32% bracket, pays $19,200 on the same $60,000. Same money, $6,000 more in tax, just because of timing. Multiply that effect across 10 years and across a $600,000 account, and the difference in total tax paid can be staggering. David had the option in year 1 to take a substantially larger distribution during a period when he could have managed his total income more carefully, perhaps deferring a bonus, maximizing retirement contributions, or harvesting investment losses to offset the income. He did not know this was an option until year 2 had already passed. Strategy 2. Roth conversions before inheritance. This is a planning strategy for the IRA owner, not the beneficiary, which is exactly why it matters to act now rather than later. A traditional IRA grows tax-deferred, and distributions are taxed as ordinary income. A Roth IRA grows tax-free, and qualified distributions are entirely tax-free. If the original account owner converts traditional IRA assets to a Roth before death, the beneficiary who inherits the Roth IRA still faces the 10-year rule, but all distributions during that 10-year window are tax-free. This is one of the most powerful estate planning moves available to people in their 60s who have significant traditional IRA balances and children who are in their peak earning years. Consider the math on a $400,000 traditional IRA. The owner converts it to Roth over 3 years, paying tax at their current 22% rate, a tax cost of approximately $88,000. The beneficiary inherits a Roth worth $400,000 plus and takes 10 years of tax-free distributions while the account continues growing. The alternative, the beneficiary takes distributions over 10 years and pays 32% on every dollar, a tax cost of over $128,000. The conversion saves the family roughly $40,000 in tax on the same account, even after accounting for what the owner paid upfront. According to the IRS, Roth IRA distributions to beneficiaries are qualified and therefore tax-free as long as the Roth account was established at least 5 years before the distribution. This 5-year clock starts from the year of the first contribution to any Roth IRA, not the specific account being inherited. So the sooner an account owner opens a Roth, even with a small contribution, the sooner that 5-year clock starts running for every future Roth account they own. Strategy 3, charitable giving through the IRA. If the account owner has charitable intentions, leaving IRA assets to a charity or a donor-advised fund at death eliminates income tax entirely on those dollars. Charities are tax-exempt entities. They receive the full IRA balance with zero income tax withheld. The account owner's other assets, appreciated stock, real estate, cash, can then be left to family members who inherit those assets with a stepped-up cost basis at death, meaning zero capital gains tax on any growth that occurred during the owner's lifetime. This strategy is called asset location for charitable giving. Instead of leaving your IRA to your children and your appreciated stock to charity, you reverse it. The charity gets the fully taxable IRA dollars and pays nothing. Your children get the appreciated stock and pay nothing on the lifetime growth. Both groups receive the same total dollar amount, but your family ends up with significantly more after-tax wealth because you match the right asset to the right recipient. Strategy 4, name a see-through trust as beneficiary. For beneficiaries with special needs, creditor concerns, or spendthrift behaviors, naming a properly drafted see-through trust as the IRA beneficiary can protect those assets while preserving the 10-year distribution window. The trust must meet specific IRS requirements to qualify, otherwise it is treated as a non-person beneficiary, which compresses the timeline to 5 years instead of 10. This area requires careful coordination between your IRA custodian and an estate planning attorney who understands the Secure Act requirements in detail. Done correctly, it adds a layer of asset protection without sacrificing time. Done incorrectly, it accelerates the tax liability by cutting the distribution window in half. Here are the 5 mistakes that cost heirs the most money when inheriting an IRA. Mistake number 1, assuming the old stretch rules still apply. The stretch IRA ended on the 1st of January 2020. Any beneficiary who inherited after that date and is not an eligible designated beneficiary is subject to the 10-year rule, no exceptions. If you have been told to let the account sit and grow with no distributions planned, you may be heading toward a forced distribution spike in a high-earning year. Talk to a tax professional now, not in year 8 or 9. Mistake number 2, planning to take everything in year 10. Delaying all distributions to a single year 10 lump sum sounds appealing. More time for the account to grow, maximum deferral, but for most beneficiaries, a single year distribution of $600,000 creates an income spike that pushes them into the highest federal brackets, triggers IRA surcharges on Medicare premiums, phases out deductions, and may make a portion of Social Security taxable. A modeled 10-year distribution schedule almost always produces a better outcome than deferring everything to the end. Mistake number 3, inheriting a Roth IRA and assuming it is entirely tax-free. Inherited Roth IRAs are subject to the 10-year rule just like traditional ones. But Roth distributions are only fully tax-free if the 5-year holding period was satisfied before the original owner died. If the deceased opened their first Roth account less than 5 years before death, distributions of earnings may be partially taxable. Check the original account opening date with the custodian before assuming every inherited Roth dollar is tax-free. Mistake number 4, missing annual required minimum distributions when the original owner had started theirs. If the IRA owner had already begun taking required minimum distributions before they died, the beneficiary must take annual distributions during years 1 through 9, not just a final distribution in year 10. Missing one of these annual distributions triggers a 25% IRS penalty on the amount that should have been taken. Secure to reduce this penalty from 50%, but 25% on a $60,000 missed distribution is still $15,000 in avoidable penalty. Ask the custodian explicitly which rule applies to your account. Mistake number 5, no living beneficiary on the account. When an IRA passes to an estate because no beneficiary was ever named, or the named beneficiary died before the account owner, the distribution window shrinks to 5 years if the owner died before their required beginning date, or is based on the remaining life expectancy of the deceased if they had already started distributions. Either way, the result is a compressed, accelerated tax hit that could have been entirely avoided with a single form on file at the custodian. Review every retirement account. Name a living primary beneficiary. Name a contingent beneficiary as a backup. Review it after every major life event. Here is your action plan for the next 30 days. In week 1, find every retirement account you own, every IRA, every 401 CAC, every 403B, every SEP or simple IRA, and look up the beneficiary designations currently on file. Do not assume the form you filled out when you opened the account 15 years ago still reflects your intentions. Name the primary beneficiary. Name a contingent. Verify that both are living, correctly spelled, and reflect your current family situation. In week 2, if you have already inherited an IRA, determine exactly where you are in the 10-year window. Call the custodian and ask 2 specific questions. Was the original owner taking required minimum distributions before they died? And am I required to take annual distributions or only the 10-year final withdrawal? Get the answer in writing, and if annual distributions are required, confirm the amount due for this calendar year before December 31. In week 3, if you own a significant traditional IRA and you are between the ages of 60 and 73, schedule a meeting with a tax advisor or estate planning attorney to model Roth conversion scenarios. Ask them to project the tax cost to your heirs under the current traditional IRA structure, compare it to a phased Roth conversion over 3 to 5 years, and show you the break-even point. For most people in a lower retirement tax bracket whose heirs are high earners, the conversion math is decisive. Naylor.org and the American Academy of Estate Planning Attorneys can help you find qualified professionals in your area. In week 4, if you have a beneficiary who has special needs, creditor problems, addiction concerns, or a history of financial instability, do not leave them a large IRA outright. Instead, discuss a qualifying see-through trust structure with an estate planning attorney. It is a more complex solution, but it combines the protection of a trust with the benefit of the full 10-year distribution window. One more thing worth understanding. This does not only apply to IRAs. 401ks, 403bs, SEP IRAs, and simple IRAs inherited from a non-spouse after the 1st of January 2020 are all subject to the same 10-year rule. If you have been thinking of this as an IRA problem, expand that to include every employer-sponsored retirement account your parents or grandparents may have left behind. The custodian may be a former employer, not a traditional brokerage, which means you may have to track down the plan administrator, roll the account into an inherited IRA, and then manage the 10-year distribution from there. That rollover process can take weeks, and during that time, the clock is still running. The Secure Act fundamentally changed what it means to inherit a retirement account. The stretch IRA that many families were counting on is gone. What replaced it is a compressed, taxable window that catches most heirs completely unprepared. But preparation is available. The strategies exist. The planning tools are in place for anyone willing to act before the clock starts running. I am Marcus Webb. If today's episode changed how you think about the retirement account you are building or the inheritance you are expecting, share this with someone who needs to hear it. Leave a comment below with the one action you are taking this week. And if you are not yet subscribed, do it now and ring the bell. Every week, we cover the estate planning moves that most financial advisors never bring up until it is too late.